Financial markets have been relatively confident in the pathway for rates in the US following that jobs report that, of course, saw a major write-down in terms of the May and June payrolls figures alongside a miss on the July number. So does that mean that we've got a clear pathway to lower rates at every meeting? Not necessarily so. The fear for the Federal Reserve has always been on the inflation front. Tariffs, of course, now being locked into place, maybe below where some of them had been expected. But inflation risks remain, and that's why this week's CPI release will be a key one for markets to watch out for. So first and foremost, let's look at the outlook for what to expect from this report. You can see in terms of market expectations, 0.2% on both of the monthly metrics, headline and core. That, I think, is the most important part of it, right? So you do have those year-on-year figures, and of course we have a 2% target, so the year-on-year figures are always going to come into play at certain points, and certainly they're worth watching out for. But of course, the trajectory of prices over the near term will be reflected by what's happened over the course of the past month and recent months. And so 0.2%, if that's what we see, yes, that emboldens us in terms of thinking that we will see a Federal Reserve that can essentially do what they want and continue to look forward with a mindset that they're going to be easing. Now, in terms of how we've been seeing things on that month-on-month basis recently, you can see a little bit of a resurgence recently above that 0.2 mark. Now, I would say on average, you want to stick around 0.2 and below to get back to that 2% target. We sort of have moved a little bit above it. So there are some concerns that tariff pressures are starting to feed in to the US economy, but not massively so. Certainly, if you compare us to where we were at the back end of last year, we're significantly below that. We didn't have tariffs at that point. So, you know, that sort of signals the ability to potentially look through what we're seeing at the moment. Of course, there's concerns, and those concerns have come through different areas, right? So we've seen a number of surveys, particularly around the manufacturing sector, that highlight the resurgence in terms of price pressures. You can see it here, the Philly Fed prices paid, the Richmond Fed prices paid, the ISM manufacturing, you know, a number of them here, all surging towards the upside. And so you can see that businesses are by and large reporting that they're seeing price pressures coming into play. Does that mean that we're going to see that in terms of inflation? Well, there's a strong chance of it. And certainly it's worthwhile noting that many of these companies will report price pressures, but they may not necessarily have passed it on to the consumer. They may not have done so because they're swallowing it themselves, so they might not do so because they've built up inventories and therefore they're just selling off those inventories before they actually start to push that on the consumer. But certainly it doesn't necessarily mean because we haven't yet seen a resurgence in terms of price pressures that it's not going to happen, because there's often a lag between policy and what actually happens in terms of what people are paying in the shops. In terms of the last report, this was something that came out of it, you know. Certainly when we first saw the numbers, everyone was saying, oh, by and large, everything's under control. And then you drill down a little bit into it and you start to see a number of different elements where inflation is rearing its head. You can see video equipment, shirts, dresses, audio equipment, footwear, the kind of things that you will import from places like China. And so these are the kind of areas that we're going to be watching once again. Do we continue to see a resurgence? And it's these consumer goods that continue to rise in terms of prices. That remains to be seen. And certainly, of course, there's still the argument that the Federal Reserve's willing to look beyond some of that. In terms of the sort of 12-month outlook, but looking at it in a number of different ways, you can see that shelter, which is the biggest component into inflation, continues to drive sort of downward pressure on headline inflation, because you can see that blue line, the light blue line at the top. It's relatively slow moving. You look at where the peak was compared to the peak for the rest of these metrics. So it takes a while to turn around. And at the moment, the trajectory is downward. So that should put downward pressure on inflation as a whole. If you look at some of the other metrics, we have started to see them turn towards the upside of late. In terms of the sort of breakdown, like we've seen here, this sort of gives you all wrapped up into one. Headline CPI 2.7, core 2.9. We've seen a bit of a resurgence in terms of monthly metrics in the middle. In terms of the 10-month annualized, so at the current pace, where will we be in a couple of months' time? Not necessarily seeing any major uptick at the moment. In terms of the outlook for the Federal Reserve, like I said, really, it feels like at the moment markets are really looking towards the Fed and thinking, now that you've seen this weak jobs report, which was essentially 258,000 jobs wiped off of May and June, and then you had the July number coming in low as well, markets are now saying essentially the underlying strength of the economy that you've based much of your decisions on isn't there anymore in terms of the jobs market, because we have been seeing weakness in terms of other metrics. Of course, the ADPs have been very weak during this time, and everyone says, look how useless the ADP is now. And in actual fact, it was right. The weakness of the ADP was right. So maybe we love the ADP again from now onwards. But ultimately, in terms of the outlook from the Federal Reserve, part of it will come down to the jobs report, part will come down to inflation. So if inflation remains under control, then yes, that pathway lower remains in play. And as you can see here, we're expecting between 2 and 3 rate cuts for the remaining 3 meetings this year. At the moment, the highest percentage is attributed to 3, but bear in mind that 2 can also go wrapped up with the view that we only see 1, and in which case that sort of takes it as the base case scenario that essentially we see 2 or less rate cuts. Essentially here, I think it's something like 45% that we are expecting, that markets are expecting 3 rate cuts. So that's where the adjustment's going to take place, right? If we continue to see inflation remaining low, then the view of 3 rate cuts for the remainder of this year is likely to be emboldened. If we see this inflation report again start to show a resurgence in terms of price pressures at the hands of these tariff levels, then you see the possibility that we see a shift in favor of 2 rate cuts rather than 3. And so that's certainly something to be watching out for. Now, this is a tool that is open to all, so you are able to check this any day of the week that you want. This is the CME's FedWatch tool. So make sure to check this, and you can see exactly how markets are reacting on a daily basis to the data and the news that's coming out. So certainly keep an eye out on this on Tuesday after the inflation report. It should give you a good idea of where sentiment is going from here. Now, in terms of markets, now let's kick off with the US dollar. This is the US dollar against the Japanese yen. Excuse me. And what we can see here is that price is starting to regain a little bit of ground following this sharp pullback that we saw. That sharp pullback was coming off the back of the jobs report, right? So did we get a little bit carried away with the expectation that the Fed is suddenly going to be uber dovish from here on in? And should the bulls come back into play? Well, certainly from a trend perspective, you can see that this trend does still remain in play, this resurgence. We've come into this 76.4 Fibonacci support level and starting to regain ground. Certainly if we were to break up through your near-term resistance level, which comes around this zone here, so 147.8, 148, that kind of zone, if we break through it, you've got this little double bottom formation and it points towards the bulls potentially being back in play. And certainly if we do see a strong inflation report on Tuesday, that's the kind of reaction I would expect. I would expect us to start regaining some of the ground that we lost around that jobs report announcement. Now, in terms of US stocks, you can see here on the Dow that the long-term trajectory, of course, is up from that low in April. You can see we're still yet to regain the highs for the Dow. That really comes down to the sort of components within it. Less of a focus on tech, but the tech names that they do have are people like companies like Apple, which haven't necessarily been sort of joining in on as much of the upside that we've seen for the likes of the NASDAQ. Nonetheless, what you can see here is that prices are starting to roll over once again. We've seen a rally and a potential retracement following this breakdown through support. So the breakdown through this support level here signals that the next rally is potentially a retracement before the bears come back into play. If we get the 4-hour chart in here and just zoom in, let's just see exactly where we've come from a fib perspective. So into that deep zone and starting to weaken once again. If we break higher, then great, but we really need to break up through this big resistance level here into all-time highs of 45073. Until that happens, there is a risk, and certainly this bearish engulfing candlestick formation at the moment signals the possibility that we come into a deeper pullback. That pullback in my mind would be a retracement of this move here, and in which case the zone you'd be looking at is 42702, 43148. That would be the zone where I think we would bottom out if we did see that next pullback. But certainly I do view all of this at the moment as a retracement of that rally up from essentially 4200. It's just the method by which we sort of retrace and then recover is different each time. So keep an eye out on this. And certainly if we do see some particularly heavy inflation numbers, that could drive this market lower over the near term. But I don't necessarily think it'll be the beginning of a massive collapse here. Then finally, let's look at gold. Now, gold on the top end, you can see that by and large, we've got this sort of resistance zone of 3438. We're not necessarily there at the moment. On the bottom end, we've got this zone down here, which is sort of 3245, that kind of area. So we're closer to the top end than the bottom of this range that's been dominating recent months. Do we see any signal that we're rolling over? Well, at the moment, we've sort of seen this consolidation and we're within that next break higher at the moment. It points towards a possibility of further gains over the near term. If we see this from a sort of trend line perspective, let's just go down to the bottom down here. No, that's not great. So let's do it again. And we'll do it from this initial point here. There we go. That's a bit cleaner. So we've got trendline support here at the moment. If you want to see a level beyond which, if we break it, then it starts to look like we're rolling over. I'd say this sort of swing low here, because you can see that we've rallied up, pulled back. We haven't broken through that prior high, which means we could be seeing an ABC style retracement of that rally. Let's see if fib comes into play here. So yes, 76.4, absolutely perfectly tagged. So the bulls still remain in play in my mind, unless the 33.71 points towards a wider retracement here for gold. But essentially, we are coming towards the top end of this range. And certainly gold benefits from easing, right? Gold benefits from the idea that we're going to see the Federal Reserve cut faster and by a higher degree. So that means if we see weak data in terms of inflation, it should embolden the bulls for gold and drive us back towards that resistance level of 34.38. But if we don't, if we see a worrying rise in terms of inflation, it could undermine the idea we're going to see 3 rate cuts for the remainder of this year, and instead point towards 2 or less, and that could drive gold lower over the near term. From a wider perspective, always be wary of the trend, and the trend is your friend. It's definitely a very bullish one. We're set within this sort of consolidation phase over the past few months. I do expect a breakout towards the upside before too long, but ultimately I always just say, you know, it's all well and good expecting it, but for me, you know, play it once you've either taken a retracement and then you get the full move leading into that breakout, or you play the breakout. I wouldn't necessarily be looking for longs just below that resistance level, because of course there's a strong chance that we see more of the same and that price action respects it and starts to move back into the midpoint of that range once again. I hope that's been useful. Make sure to like, subscribe and follow for more content like this. Like I said, it's going to be a massive inflation report for the week ahead. And make sure to check out the week ahead, another video that I've created, which also provides a dive into the likes of the RBA interest rate decision and data coming out of the UK as well. Have a great day, a good week, and good luck trading. Thanks a lot.